Welcome to the deep dive. Our mission really is to cut through all the noise and give you those key insights, the things you really need to understand complex topics. And today we're tackling financial securities, but from a really unique angle, Islamic finance. If you've ever been curious about how investments line up with Shari'ah principles or, what actually makes something okay versus not okay, then this is definitely for you. We're aiming to give you that shortcut to being properly informed, maybe with some surprising facts along the way.
Absolutely. And our guide through this pretty intricate area is a really foundational document for Islamic financial institutions, Sharia Standard number 21. You should think of it less like just a rule book and more like a carefully developed framework. It gives clear Sharia rulings, specifically on shares and bonds. So our job today is to pull out the most important bits, the key knowledge nuggets from this standard, to help you get a quick grasp on the essential principles for issuing and trading securities, all through that Islamic lens.
Okay, right. Let's unpack this then. Sharia standard number 21. What exactly is it, and what's its main objective when we're talking about financial securities? It sounds pretty significant.
Oh, it absolutely is. It was adopted by a Sharia board back in May 2004. Specifically sometime between the 20th and 30th of May, which lines up with 2030 Rabi al-Awwal 1425 in the Hijri calendar. A key moment for the standard. Its main purpose is, well, it's twofold and quite clear. First, it sets out the Sharia rules for shares in joint stock companies. And importantly, it details the controls that Islamic financial institutions need to follow when they issue and trade those shares. And second, it directly addresses interest-bearing bonds, makes it crystal clear they are not allowed. They're considered riba interest, which, as you know, is prohibited in Islam.
Okay, so it covers shares in detail, but also takes a very firm stance against conventional bonds. That seems like a pretty wide scope for just one standard.
It is, yeah. The reach is quite impressive, actually. It covers issuing and trading shares, sure, but it also digs into a whole range of related financial contracts.
Yeah.
Think about investment agreements, trading setups, leasing, lending, pledging shares, even specific Islamic contracts like salam, that's a type of forward sale, or istins, which is like a manufacturing contract. It even touches on things like options and exchange contracts. So, yeah, it's broad, but that really shows how Standard 21 tries to connect with, the whole spectrum of modern finance, making sure everything fits within Islamic principles. It's about thorough ethical guidance.
That's really interesting how it weaves into so many contract types. Okay, let's zoom in on shares then. Say a company wants to raise capital, issue shares. What are the first Sharia hurdles they need to clear?
All right, the first one, the absolute foundation, is that the company itself has to be set up for a Sharia-compliant purpose. Its main business activity has to be permissible. So if the core business is something forbidden, dealing in alcohol, gambling, conventional banking involving interest, then issuing shares for that is just not allowed. Simple as that. The whole basis must be ethical. Beyond that fundamental point, thinking about issuance costs, it's okay to add a specific pre-estimated percentage to the share price when issuing them, to cover legitimate expenses, as long as it's a reasonable estimate. And things like capital adjustments, issuing new shares later to raise more capital, or revaluing existing shares. That's also permissible. But it has to be based on a proper expert valuation of the company's assets.
Seems fairly logical for the initial setup. What about guaranteeing the share issuance? Is that allowed? Any catches there?
Yes, guaranteeing the issuance is generally permissible. The key thing, though, is that you can't demand a separate payment just for providing the guarantee itself. That prevents it from becoming a kind of side bet. Oh, and shares can be paid for in installments too. That's allowed. But here's an important detail. The actual transfer of ownership doesn't happen until the share value is fully paid up.
Okay, now this next bit I think is really interesting, especially if you're used to conventional markets. I've heard Islamic finance looks at different types of shares differently. What's the deal with preferential shares?
Ah, yes, you're right. That's a major point of difference. Under Standard 21, it's impermissible to issue shares that have special financial features, like giving them priority when profits are distributed, or if the company liquidates and capital is repaid. Why? Because those kinds of features, well, they clash with the whole idea of partnership musharaka in Islamic finance. The core principle is that risk and reward should be shared fairly among all partners, all shareholders.
So everyone should be on a level playing field, basically.
Exactly, on the same footing. And similarly, you can't issue shares that grant special procedural rights or, extra administrative control compared to ordinary shares. Fundamentally, shares are seen as just common ownership certificates in the company's actual assets. Doesn't matter if it's issued in the owner's name or as a bearer document. It really reinforces that idea of true equity.
That makes a lot of sense, yeah. Focusing on real partnership. Okay, so the shares are issued, they're out there being traded. What are the Shari'ah rules for the actual trading? Are certain transactions okay and others not?
So the general rule is buying and selling shares, whether for immediate settlement or deferred, is permissible if the company's main business is Shari'ah compliant. Doesn't matter if you're holding for long-term investment or actively trading. But, and this is a big but that comes up all the time, what if a company isn't perfectly pure? What if it has some non-permissible activities alongside its main okay business?
Right, the mixed activities problem, that must happen a lot. How does Islamic finance handle that gray area? Because, the real world isn't always black and white.
Precisely. And this is where the standard gets quite practical. First off, the company's constitution, its founding documents, absolutely cannot state that its main objectives include riba or other forbidden dealings. That's a red line. Then you get into these strict financial limits, these thresholds. The total amount of interest-bearing loans the company has, short-term, long-term, all of it must not be more than 30% of its market capitalization. So it limits how much they rely on conventional debt.
30%, okay.
And the second threshold relates to income. Any income the company gets from prohibited activities cannot exceed 5% of its total income.
Wow, 5%, that's quite a small tolerance.
It is. These specific numbers show, I think, a pragmatic approach. It acknowledges that perfect purity might be hard to find, but it keeps the non-compliant part very much in the minority, ensuring the core business and finances are overwhelmingly okay by Shari'ah standards.
Okay, those percentages are super specific. So let's say a company squeaks by, meets those limits, but still has, I don't know, 4% of its income from something dodgy. What happens then? Do investors just ignore that bit?
No, not at all. And this is where you get the concept of purification, or tathir. It often surprises people new to this. That portion of income, the bit derived from impermissible sources, however small it is, needs to be purified. Basically, the shareholder has to get rid of it, typically by giving it to charity. This applies whether the income came directly from a forbidden activity or just, as part of the ownership. And it needs to be done usually at the end of the financial period. The amount you purify is proportional to your shareholding's part in that forbidden income. And, importantly, the financial institution managing the investment is usually responsible for calculating this and facilitating the purification. Makes it manageable for the individual.
That's a really interesting mechanism for ongoing ethical accounting. Okay, so that covers the company itself. What about how people trade the shares? Are certain trading strategies forbidden?
Well, definitely. The standard is very clear about prohibiting certain practices, especially those seen as overly speculative or debt-driven. For instance, you absolutely cannot buy shares using borrowed money. That's margin trading. And you can't pledge shares you own to get such a loan either. The idea is to avoid excessive leverage and debt risk. Also, short selling. That's selling shares you don't actually own, hoping the price drops so you can buy them back cheaper. Strictly prohibited. It involves selling something you don't possess, which is a problem, and it's seen as purely speculative. And there's more. Lending shares is generally not allowed if the purpose is, for the borrower to sell them and return them later, or just to get the dividends, or maybe to artificially boost someone's financial statement, things common in conventional markets. This is a big one. Derivatives. The standard explicitly prohibits dealing in things like forward contracts on shares. Salam on shares is viewed differently than a basic salam contract on commodities, mind you. Also, futures contracts, options contracts, and swaps involving shares or their returns. These are generally out.
Why is that? What's the main concern with derivatives?
The prohibition often comes down to concerns about excessive uncertainty, or gharar. That's a key concept in Islamic finance. It aims to avoid transactions where there's just too much ambiguity about the subject matter or the outcome, making it resemble gambling or maisir. Islamic finance really wants transactions tied to tangible assets, to real economic activity, not just betting on price movements on paper.
That idea of gharar, avoiding excessive uncertainty, really helps explain why many common derivatives are problematic. Okay, what about a situation where a company's assets are mostly, say, cash or debt? Does that affect how you can trade its shares?
Yes, it absolutely does. Another crucial point. If a company's balance sheet is dominated by liquid assets, like if cash plus debts make up more than, say, 30% of its total assets, then some special Shari'ah rules kick in. These are rules related to currency exchange, known as sarf, or rules about trading debt. These rules restrict the normal trading of shares in such companies. Why? Because you're essentially trading money for money, or debt for debt, and that has very strict conditions to prevent riba. And similarly, if a company's main business is actually dealing in currencies or gold or silver, then trading its shares must strictly follow the rules of currency exchange too. It shows how the nature of what the company owns really impacts the trading rules for its shares.
So wow, shares have these incredibly detailed conditions: issuance, trading, mixed activities, purification, prohibited tactics, even asset composition. It's a lot. What about bonds then? Does Sharia Standard 21 go into some more detail for them?
With bonds, the standard is actually much simpler and extremely direct. It prohibits the issuance of all types of interest-bearing bonds, period. Doesn't matter if they're issued by private companies or governments, even zero-coupon bonds fall under this. The fundamental reason is that they all involve a condition of getting back more than the principal amount loaned. That guaranteed increase is the definition of riba, interest, and it's forbidden because it disconnects profit from actual economic activity and risk sharing.
So no wiggle room at all on interest-bearing bonds.
None whatsoever. And because issuing them is forbidden, it follows logically that trading them, buying, selling, pledging them, any dealing, is also strictly forbidden. It's a very clear line.
Okay, so if conventional bonds are completely out, what's the alternative in Islamic finance? If a company needs to raise debt-like capital, or if investors want something providing regular returns?
That's the essential question, right? And it shows Islamic finance isn't just about saying no. It offers constructive alternatives. The standard explicitly points to investment sukuk as the Sharia-compliant alternative to bonds. It even references another standard, Sharia Standard number 17, which deals specifically with investment sukuk, acknowledging it's a whole topic in itself. Sukuk aren't debt instruments in the conventional sense. They're more like certificates representing ownership in underlying tangible assets or services or projects. The returns investors get are linked to the actual performance of those assets, not a predetermined interest rate. So it aligns with the core principles of asset backing and shared risk and reward. It's a fundamentally different approach.
Wow, okay, that really was a deep dive. It's genuinely impressive how detailed Sharia Standard 21 is, setting out this whole framework for figuring out what's permissible and what's not, especially with shares and bonds. What really stands out is that stark difference, isn't it? Shares are conditionally okay, but with all those rules, thresholds, purification, but conventional bonds, a clear no, and then sukuk stepping in as the alternative, it's a totally different way to view these instruments.
Absolutely. And I think it's important to see the why behind these rules. It's not just random. The underlying philosophy is about promoting fairness, discouraging pure gambling-like speculation and really pushing for investments tied to the real economy where risk is genuinely shared. Standard 21 shows that Islamic finance isn't just a list of prohibitions. It's a comprehensive system aimed at fostering financial practices that are ethical, fair, and hopefully more stable. It's a principled approach gaining more traction globally.
It makes you think, doesn't it? Seeing these very specific, detailed standards applied to modern finance really highlights the depth of Islamic jurisprudence in adapting. It offers this robust, principled alternative for economic activity. And the provocative thought maybe is, looking ahead, as global markets keep changing and maybe more people look for ethical options, what sort of new innovations might actually grow out of these principles in the coming years? It certainly keeps the future of finance, both conventional and Islamic, incredibly interesting to watch.